Good afternoon, everyone. Thank you very much for joining us today. Today's session is being run by Quentin Hill, who's the Managing Director of Carpentaria Resources. And Quentin is going to be talking through, we've recently seen a big upswing in, some of the share prices, some of the major global players in the iron ore area. Iron ore prices have recently broke the $100 mark for the first time since 2014. And Quentin's going to be running through this, what major steel manufacturers are looking for in offtake agreements, the potential for South Australia emerging as a new iron ore supply hub, and going through this and many, many more things. Carpentaria, a very interesting business. This is a significant project. They have access to produce the highest grade iron ore product on the planet, and there are particular reasons why this product is very, very valuable and is in high demand, and Quentin will lead to talk through all of that and much more. So thank you for joining us. If you have any questions throughout the presentation, please type them into the chat box, and at the end of the presentation we'll go through all of your questions one by one. And I'm just first, by way of disclaimers, any advice contained in today's presentation is general only. It doesn't take into consideration your circumstances, and you need to decide whether it's appropriate for you. And I'll put up Carpentaria's cautionary statement for just one moment, but this is available on their Investor Centre, and this presentation will also be uploaded to their Carpentaria Investor Centre in the days ahead. But today's session, I would simply be here to facilitate the questions and MC. The session will be run by Quentin Hill, the Managing Director of Carpentaria, who is very well placed to be able to talk through the industry and also what Carpentaria are up to at present. Quentin.
Hello to the listeners out there. Thank you, Patrick. Yes, I will be talking about, the headline is the iron ore briefing. I'll spend the first half of the presentation talking about the iron ore market. Happy to take questions on that at the end. It will seem a little self-serving when I get onto the project benefits, but that's only because this project, the Horsens Iron Project, is perfectly placed to meet the emerging trends in the iron ore market. So just bear that in mind. Now, let me start. Iron is the world's most important metal. It's the main ingredient in steel. It's the most used metal in the world. Steel is a key to the growing markets of renewables, and in fact steel is the third largest industry in the world with $900 billion a year turnover, and it is growing. By 2050, steel use is projected to be 50% higher than it is today. Chinese pig iron production is up 8% in the first half of this year. Peak steel shows no sign of being reached in China, and growth is forecast to continue. And we know from history that countries show generally more than a decade at peak steel production before the steel intensity of a nation starts to fall. So there's plenty to run in China's steel demand. Demand forecasts remain typically strong also for India, Vietnam and other developing economies, and they are set to sustain growth in iron ore and steel demand for decades. Now, the Brazilian disaster has reduced global supply. It's dropped considerably. This has increased the price substantially from around $65 to $110 a tonne or more. Patrick mentioned the price spikes of the majors, up 20 to 75% in that time. The Brazilian disaster has had a tremendous effect on the iron ore price. That is clear. High-cost Chinese producers have entered the market to fill the supply gap. When will Vale production be restored and perhaps prices come off? It's an interesting story. Of the original 93 million tonnes of production cuts, 30 million tonnes came on last year, or last quarter, I should say, when one of the newest mines, presumably with good safety, Brucutu, was allowed to restart. That leaves 63 million tonnes. Of that, 30 is dry processing, and Vale says that will gradually come back starting next year. Well, I actually believe that these are higher cost mines in the south, and production is more likely to not come back or be replaced by continued ramp up of mines in the north. The miners are managing value over volume at the moment. the decreased volumes at higher prices actually means Vale is generating more cash now than before the accident. The last 30 million tonnes to come back on is critical wet processing production. It's not likely to come back for years. Certainly if Samarco is anything to go by, after 5 years there is still no production because these wet processing production, it needs tailings dams and they are the source of the accident. So what that affects is supply to the high quality pellet feed market. That is the growth market in iron ore, which I will explain shortly. You cannot make high quality pellet feed without wet processing. Water is needed to grind fine enough and in most cases to upgrade and used in most cases to upgrade the iron content. As an example, Vale or evidence, Vale recently cut its pellet guidance for this year from 60 to 45 million tonnes. That's a 25% drop. So the market is starting to realise this and get worried, particularly in the Middle East, but more on that later. Analysts are also forecasting more supply disruptions from maintenance in the Pilbara and India resetting of its iron ore mining permit system in 2020 to 2021. So there appears to be, 2, 3, 4 years left to run on these supply constraints. The strong trends towards high quality ores have been overshadowed by the iron ore supply crisis. They're still there. The push to pellets and high grade iron ore caused by higher environmental costs, they're getting higher, and it's also caused by the structural shift in technology with larger furnaces starting to dominate production in China. These work best with high quality inputs, so the investment decisions have baked in these trends to pellet feed. Now, the forecast lift in pellet use in China is from 14 to 18%. CRU and Vale have estimated a pellet feed market supply gap because of this of around 50 million tonnes by 2022. Now that was before the Vale accident and the stop to wet processing for 30 million tonnes. So that number is much, much higher now. Over the Chinese winter, we expect to see these trends re-emerge as the environmental-based industrial production kicks in. Production cuts kick in, again to limit pollution. This means overall demand for iron ore drops, but demand for higher quality ores increases because they increase productivity and reduce pollution. Mills can maintain overall production and still comply with restrictions if they use high quality ore. This is what we saw last year and indicative of the long-term future trend. Also, with these higher prices that we're seeing, we are seeing more interest from Chinese SOEs once again starting to consider investing in equity supply as a natural hedge to high iron ore prices. Okay, so all of these trends are being borne out by the majors. The head of Rio Tinto has said, in the context of new environmental policy introduced by China, even if the consumption of steel was to fall, the need for high quality ore in order to improve environmental footprint, and that's what we have experienced, it will increase, and that's what we've experienced in the last few years. The market has pivoted towards high-grade inputs. FMG recently approved the $2.6 billion Iron Bridge project for 20 million tonnes of high-quality magnetite, not quite as good as ours, to protect its market share. Low-grade iron ore producers will lose market share in the long term. This is what FMG's response is. New higher quality projects are needed to meet this demand. Our Horsens is recognised as the leading project of its type, and very few of these high quality projects are bankable at long-term iron ore prices, and I'll show you more of that soon. Elsewhere, grand steelmaking visions are being studied closer to home. Sanjeev Gupta wants to make 10 million tonnes of steel at Whyalla, and he's attempting to replicate what we have already done in the Braemar, albeit I think targeting much lower product quality. What this means for us is that Whyalla is a potential customer for the product. It's an endorsement from the British billionaires that the Horsens belt is the best opportunity for iron ore in South Australia, and also an endorsement of our plans to export high-grade iron ore. So the market needs new supply of high-grade ore long-term. That is clear. There are a few projects that can produce it. I'm going to tell you about the leading one now. Horsens is super grade. The product is the world's best iron ore product. We have a 10 million tonne feasibility study that puts Horsens in the leading global position with excellent returns, high margins, high project value. It says 1.1 on the feasibility study, $1 billion MPV. It's in fact $3.5 billion at today's prices. We have a $5.4 million funding commitment from Mitsui, and we are located near established infrastructure. Why are we different? The price for our product is a significant premium at around $25 a tonne on the benchmark. This transforms the metrics of our project. Our formula is $12 to $13 a tonne above the 65 index, and that is supported by customer feedback. However, there is another market, the direct reduction market in the Middle East, that uses gas, not coal, to turn iron ore into iron. You don't have to buy coal, so they can afford to pay more for iron ore. Currently, DR grade pellets are selling for $200 a tonne. That's $60 a tonne more than our pricing. Given it costs $10 to $20 a tonne to pelletise, there's $40 to $50 a tonne more value than we have allowed for. This is a huge markup for existing suppliers, principally Vale, and one that the buyers are seeking to address. Supply is not secure, and the buyers in the Middle East are looking to secure their own supply and build their own pellet plants. We are the standout feed source, and we are talking to the right groups to make that happen. Let me take some time to explain this market. DR grade means silica and alumina below 3% because the process doesn't remove the waste. Recent forecasts identify a supply deficit in this DR market out to 2025. There is a supply and quality issue because DR is not easy to make. For miners, it's about iron losses and costs during the upgrade step. If you can upgrade 65% Fe to DR grade with only 10 to 15% losses, you're doing well. If you can't, you're better off selling blast furnace grade. So the supply of DR grade is concentrated for a reason. LKAB, Vale and Anglo-American / Bahrain account for 90% of this market. It's difficult to produce. Few ore bodies are amenable to do it with low iron losses. It can be done with some special magnetite mines in Sweden. In southern Brazil, some low-grade hematite ore can be upgraded in wet processing without prohibitive iron losses, but not all, in fact fewer and fewer. Recent dam failures occurred in southern Brazil where wet processing is essential to produce a saleable product. Authorities now require onerous tailings treatment, and the approvals needed to restore the supply are uncertain. And here's the thing. Horsens is the only 100% DR grade mine and the only 100% magnetite DR mine development. It has leading metrics and is recognised as the natural fit by those in the Middle East seeking to protect against supply disruptions and price gouging. The next slide shows that our offtake partners, Mitsui is secured, the others are not. We have 140% of our production under letters of intent, half DR, half blast furnace. That's because the product has ideal physical properties. It's the highest grade iron content in the world. Magnetite is favoured by pelletizers, and this all supports our customer-led development plan. The pre-feasibility study results on the next slide show outstanding high margins, excellent returns, a high project value, and 10 million tonnes of production over a 20-year mine life, but we know that it's a lot longer than that. At $135 a tonne revenue at today's prices, that means $870 million a year in profit. The project as I said, has outstanding financial metrics. The GHD PFS results show an all-in cost of around $48 a tonne landed in China, and using the premium and consensus iron ore forecasts, a $40 a tonne margin. Today, that margin is around $87 a tonne with an equity rate of return of more than 65%. Our assumptions are looking a little conservative at the minute, potentially generating the $870 million a year profit, as I said. The capital cost is $1.3 to $1.5 billion depending on our port selection, and our payback is under 2.5 to 4 years depending on your price assumption. Horsens is a first quartile project on the Wood Mackenzie value in use adjusted cost curve, right where finance lenders need you to be. We will be at around $20 on that curve you're looking at now. It is cash flow positive at iron ore prices under $30 a tonne, managing the downside risk for lenders. There is also room to flex the price without shifting the position. The next slide is the Irr chart, the rate of return. Wood Mackenzie's most recent rate of return chart for those projects not owned by the majors shows Horsens as a clear standout. The one in red has already been committed, right? So we're well above that. That's the benchmark. None of those others will be committed. They're below 10% returns. It is clear we are next on the list, and I hope that I've shown the market needs the product. So how can we get into that leading position? It's all about the ore and the infrastructure. The soft ore gives us a $20 advantage on cost of other high quality products, and we get a $10 to $20 advantage on revenue as well over those other magnetite products. That gives us a $40 margin advantage over other magnetite projects. That's why we're the leading project. The ore type, again, there's only one type. That means we have simple mining and processing systems, low-cost methods where we concentrate on volumes, not trying to get a consistent feed to the plant. And what else? The existing infrastructure is transformational. Rail, port, power is all in place, and the water is very well defined. Negotiations are we've done our PFS, we're seeking the BFS funding. Negotiations are active with multiple tier 1 parties. We continue to move through the internal processes of these counterparties, and offtake inquiries by credible and substantial end users continue, and in fact from China are getting stronger. CAP is confident the market pool for development is very strong. Horsens has the right product metrics to take market share from the DR quality and low-grade iron ore producers. It has the right product and metrics to allow Middle East DRI and steel producers to diversify supply sources, to cause Japan and Chinese steel makers to compete for pellet feed, and cause iron ore producers and traders to compete to trade and blend a product of unique importance to steelmaking's present and future needs. You can add value to existing hematite ores by blending this product. Very few projects are likely to be profitable at long-term iron ore prices, and as I've shown, we are the leading project. The company has never been closer to offtake and is committed to developing this project, 100% committed. We have work programs now to improve mine design to be carried out using our recently raised funds. We've spent those wisely. We have the leading position as an independent DR grade and pellet feed development project, and this has gained wide acceptance with Mackenzie and in fact the miners and the buyers of this material. A number of parties have indicated to us that they will be willing to negotiate a role in development at post-BFS stage and are watching us very closely, and we keep in close contact with those parties. We are very confident the project can attract the strategic investment to unlock the value for shareholders. The prize is large, and we are taking the right steps with the right people and companies, and we won't stop until we reach production. So the next steps are to secure BFS funding on acceptable terms. We complete the BFS and approvals within 18 months. We can finance and construct within 18 to 24 months. So production is 3 to 3.5 years from achieving that funding. The project is the right product at the right time. There's a high project value with $3.5 billion at today's prices, that's US. A long life mine. The super grade product is an $87 a tonne margin at today's prices with revenue of $870 million. Well, that pays back in 2 years, in fact. We have a world-leading position which gives the market confidence in the project, and the product has the ability to attract tier one partners such as Mitsui, who have made a commitment. The scale of the opportunity is huge. We are the right product at the right time for the market.
Quentin, and if anyone who's got any questions, please type them into the chat box. There are a couple that have come through. Graham has asked, what is your turnover of production once you're up and running, and what is the profit?
So the project PFS was designed for 10 million tonnes per annum for 20 years. The resource base is 330 million tonnes of concentrate, so we would hope to extend that over 30 years. Under our PFS assumptions, which are looking conservative, the annual profit is $400 million a year, but at today's prices it's $870 million a year. Highly profitable and highly prized.
All right. Brendan's asked, what are the logistics of the operation? What port will you ship out of, and how will you get the product there?
Yeah, excellent questions, and we didn't go through the mechanics of all of that. So we will mine and process on site. Perhaps there's a map we can go to. Mine and process on site. Take power from a nearby power line. Take water from an identified aquifer 90 kilometres to the south, and then we will mine and process and slurry the material 50 kilometres to Broken Hill where the railhead is. Dewater, send the water back. There's 12 million tonnes of spare capacity on that rail line, and that will take the product either to Port Pirie or to Whyalla. Now, we are in negotiations with both of those owners of those facilities. They both want us there, and they both have 12 million tonnes capacity that we need. It's a trade-off between operating costs versus capital costs, and we'll have that finalise those discussions at the right time. But it is key for two reasons. It keeps the capital low, having the existing port and rail infrastructure there, and power for that matter. And it also reduces the risk of delays because we don't have to build a rail line or a port, right? And they're key sort of steps in keeping project metrics on track.
Okay, Simon will a lot of the workers be residing in Broken Hill?
Yeah, I was in Broken Hill a couple of weeks ago giving a talk to the local government group there. The idea is, yes, we want to maximise the benefits for Broken Hill, and it's only 60 kilometres from Broken Hill, so we expect a large component to be living in Broken Hill. That's our aim, without doubt. We owe it to Broken Hill.
Okay, Greg's asked, do you expect iron ore prices to go north from where they currently reside?
Good question, Greg. No, I don't. I think they're stable where they are. I think the iron ore the spread between high quality and low quality will get larger once I guess the Chinese production cuts come in over winter. But longer term, I think it's more likely to trend down gently as the supply shock is generally worked through. What's going to keep it high is that it's currently relying on the marginal production from China, which is filling the supply gap. Okay, so once more supply comes into the market, then more Chinese production closes, and that will bring down the marginal cost of production. But that's going to be a very slow process over the next few years.
Okay. John's asked, why are the Chinese steel developers seeking imported ore rather than supplying from China miners?
Yeah, so the Chinese are very high cost. I think that their cost of production in China is around $80 a tonne or more. So they can, in effect, get cheaper supply from the seaborne trade, from importing iron ore. And they just don't have the quality or the quality of the resources or, quite frankly, the amount, the volume of the resources. They need to rely on imported trade. And in fact, they're shifting most of their steel industry to the coast because that is the cheapest way to get iron ore. What it does, though, Patrick, I think that the question assumes that yes, they don't like the high prices at the moment, and so that's incentivizing them to again look to invest in projects like ours to secure supply at cost.
All right, Peter's asked the question, and I'll kind of merge this into Daryl's question as well. When can we expect more news about offtake deals like Mitsui? How much more work do you have to do to sign more potential customers? Is there a risk that, with prices high, this won't get into production quick enough?
Look, they're all good questions. I think I'll deal with the first one first. As I've said, I think that the iron ore price is going to be high for quite some time. In saying that, this project is one of the very few that is bankable at the long-term iron ore price forecast and was before the accident, right? Mitsui signed on before the accident. So I think we're on solid ground there. And for big projects like this, you need to be able to be bankable in those different cycles anyway, right? Again, I can't talk about timing. When we have something to say, we will. But I will say, trust your judgment in the fundamentals I've provided today. Regarding what work people are asking us to do that we mentioned in our quarterly report to better define some project aspects. Look, overall, the DD has been very positive and some groups just required some more certainty in some areas. For instance, recent feedback requires an alternative dam design for one party. The current design is the same that failed in the Brazilian dams. That's a corporate requirement. The dam safety parameters of what we've done are really very safe. And there's a whole different regime in dry, arid areas compared to steep, high rainfall areas. In fact, in Broken Hill, the evaporation is 10 times the rainfall, so there won't be any mass slurry falls, that's for sure. And look, we're doing some more work on geotech and demonstrating the ore variability or the very low ore variability, and we expect those things to help. Will this accelerate the investment from other parties? I guess that's a matter for them. Some have spent a large amount of resources and see a tremendous opportunity here with Horsens. So I think yes.
Jeff, why is the premium value so high for high-grade ore? What are the benefits of processing operations to produce steel with high-grade iron?
So high-grade iron, I guess what you do in a blast furnace or in a DRI furnace, the more iron units you have compared to waste units you have, the more unit of energy and time goes to produce iron. So that just increases your productivity. That's it in a nutshell, right? The higher iron content of your feed, the higher productivity and the lower pollution per tonne of steel. I hope that answers the question.
All right, beautiful. Now, if anyone has got any final questions, we're happy to put them to Quentin while we've got him here. If you would like more information, I would encourage you to just visit Carpentaria's website. We'll have this presentation up there in a couple of days. You can speak to our team here. Blake is tasked with managing the Carpentaria relationships, and we basically just facilitate the answers you need back to the business, and of course run sessions like today as a way of being able to give you direct access to the company themselves and get your questions answered by Quentin himself. So if you have any final questions, please put them through. Daryl has asked, how much will the construction of the mine cost?
Okay, so the capital cost, depending on the port we choose, is 1.3 to 1.5 or 1.5 billion dollars, including the working capital. That's US. That's the construction. On our conservative PFS assumptions at a $60 iron ore price, benchmark iron ore price, $60, that gets paid back in about 4 years or less. At today's iron ore prices, that gets paid back in less than 2 years.
Beautiful. Okay. So yeah, look, if any final questions, please put them through now. Otherwise, I think Quentin, great job. I think we'll call the session to a halt. Thank you very much for those of you who have taken the time. If you've got any further questions, please, we will follow up with those on your behalf and get answers for you. Otherwise, Quentin, I'll leave the last word with you.
Thanks, Patrick, and thanks to all those who've taken the time to understand the market and the story. The bottom line is the prize for this project and this company is very large and it's worth chasing. There is a real need for us in the market. If not us, then who? We are astutely spending the funds raised to maximise the opportunity, and we will continue until we are in production. It'd be great to have you on board. Thanks, Patrick, and thanks to the participants.
Beautiful. Thank you, everyone. Cheers.